Okay, let's get right into the numbers today. Welcome back to Iron Financial. This is the channel entirely dedicated to helping you forge a significantly stronger portfolio and, frankly, cut straight through all the market's current weakness. I am your lead analyst. I focus purely on the hard data, the debt, the revenue, and the actual structural integrity of the businesses we cover. And as always, I am joined by our resident market skeptic. Today, we're bringing you a really rigorous, no-nonsense explainer of Dollar General's Q1 2026 earnings. Listen, if you want to build wealth that actually lasts, hit that subscribe button right now because we are about to tear into this data and see exactly what this massive retail giant is built on.
That's right. I'm here to ask the questions that I know you are all thinking at home. Is this company actually building something durable? Or is Wall Street just hyping up a total house of cards right now? Look, retail right now is a bloodbath. It just is. Inflation is completely crushing discretionary spend, and we're seeing some massive legacy household names report just disastrous numbers. So I really want to know if Dollar General is weathering the storm, or if we're going to find some serious rust under the paint.
And that is exactly what we are going to determine in this explainer. We have to ask the hard question. Is Dollar General an ironclad opportunity? And are they forging a solid, multi-year turnaround? Or is this just a value trap with hidden cracks in the armor for everyday retail investors? To figure that out, we are going to meticulously inspect the foundation of their Q1 results. We'll look at the top line, we will drill deep into the margins, and we'll examine the heavy lifting they're doing right now with their real estate and their supply chain.
Because look, on the surface, a discount retailer should absolutely thrive when consumers are stressed. That makes logical sense. But execution is literally everything. If they can't manage their inventory properly, or if they can't control store theft, it honestly doesn't matter how many customers are walking through the doors. The foundation will crumble.
Exactly. So let's stop speculating and let's start looking at the blueprint. Let's move to our first major phase of the analysis.
Section 1. Drilling down the top line.
So we are going to pivot straight to the top line revenue numbers. Listen, you literally cannot evaluate the strength of a building without checking the sheer weight it can support, right? And for a retailer, that weight is always top-line sales. We need to see if Dollar General is actively growing its structural scale or if they are bleeding market share to their competitors. And right out of the gate, here is the first massive payload. $10.8 billion in net sales for the very first quarter. That is a solid 3.4% year-over-year increase compared to the $10.4 billion they posted in the exact same quarter last year. Just take a second to really think about the sheer structural scale of that operation. They are moving nearly $11 billion of physical product in just a 13-week period. Dollar General is actively operating over 21,000 individual stores right now. That massive footprint places them within 5 miles of 75% of the entire U.S. population.
That geographic footprint is actually staggering when you step back and really think about it. You've got these massive e-commerce giants like Amazon, and they spend billions upon billions of dollars trying to crack the code of last-mile delivery, right? Meanwhile, Dollar General is just sitting there. They are right in everyone's backyard. They are heavily, heavily fortified in these rural areas where big box stores simply cannot even justify the real estate costs. That is a concrete structural moat if I've ever seen one.
Spot on. Absolutely. This revenue number firmly establishes that their foundational footprint is undeniably massive.
Hold on a second, though. Let's pump the brakes just a bit. There's a massive discrepancy here that we absolutely need to address. Sure, total net sales are up 3.4%, but same-store sales only increased by 2.0%. So the rest of that top-line growth is really just coming from bolting on brand new stores to the network. With inflation running as hot as it is and everyday goods basically costing more across the board, is a 2% same-store increase actually real structural growth? Or is it just price inflation completely masking an underlying weakness in consumer demand? Like, are people actually buying more stuff, or are they just paying more money for less product?
I fully anticipated that exact question, which is exactly why we need to look at the underlying growth drivers. We have to prove that this growth is actually real structural growth, not just an inflation mirage. So that 2% comparable sales increase, it was actually driven by a 1.4% increase in actual customer foot traffic and a half-point rise in average basket size. So physically, more feet are walking through the doors and they're buying slightly more when they do. But here is the most critical piece of data from the entire report. Management explicitly noted a massive influx of trade-ins from households earning over $100,000 a year.
Wait, hold on. Six-figure households are out there hunting for bargains in the Dollar General freezer aisle? I mean, that is a wild visual. You just don't typically associate a six-figure income with a discount dollar store.
It definitely might seem surprising at first glance, but the data simply does not lie. The wealthy are clearly feeling the macroeconomic pinch, and they are trading down to find structural savings on their everyday essentials. And listen to why this is arguably the single most important metric of the entire quarter. If Dollar General can manage to retain even a fraction of these high-earning trade-ins when the economy eventually recovers and stabilizes, their long-term structural baseline permanently shifts upward. That is incredibly bullish. Furthermore, look at their Value Valley section. This is a section consisting of over 500 rotating items that are strictly priced at exactly $1. That specific section saw an 18.4% comparable sales jump. They've even added a full frozen food door entirely dedicated to $1 items.
So they are really playing both sides of the board here.
Exactly. They are successfully capturing both their core, heavily constrained consumer who literally needs that $1 price point to survive, while simultaneously catching the wealthier consumer who is suddenly looking for a reinforced value proposition.
Section 2. Inspecting the margin foundation. So the top line is clearly holding immense weight, but now we really have to look deeper. There's an old Wall Street saying, revenue is vanity, but profit is sanity. We need to determine if Dollar General is actually converting those billions of dollars in top-line sales into a stronger, durable bottom line, or are rising costs quietly eroding their structural integrity from the inside out. And let's be totally real for a second. The macroeconomic headwinds right now are basically hurricane force. You've got SNAP benefit reductions effectively pulling cold, hard cash right out of the core customer's pocket. You've got fuel costs spiking over $4 a gallon in a lot of areas, which just absolutely destroys the rural consumer's weekly budget. And on top of all of that, they had to deal with severe winter storms in the first 2 weeks of the quarter that temporarily shut down thousands of their stores. The foundation was definitely taking a beating. You are absolutely right. The external pressure was incredibly intense. But in partially looking at the data, they somehow welded together a solid win by leveraging some massive internal tailwinds. They successfully commanded higher inventory markups, they achieved a significant, measurable reduction in shrink, and they executed much better at the in-store level, which directly led to lower inventory damages. And I want to be extremely clear about something. They didn't just blindly raise prices on their cash-strapped consumers to get those higher markups. No. They achieved this through ruthless mix management. They intentionally steered their inventory toward higher-margin private labels, and they used highly targeted promotions. They used structural, operational improvements to offset those heavy macro pressures. And here is the bottom-line payload. Operating profit didn't just survive the storm, it increased by 10.8% to $638.5 million. They successfully expanded their gross margin by 65 basis points to 31.6% of sales. Their operating margin expanded by 40 basis points. I have to admit, seeing diluted earnings per share jump 12.4% to $2 flat, which completely surpassed their own internal expectations, by the way, that shows there is some serious steel in this earnings report. To post a 12.4% jump in EPS in an environment where the consumer is supposedly getting hammered, that is a legitimate, undeniable profitability beat. It proves they actually have tremendous pricing power right now.
Absolutely. And a crucial point is exactly how they achieved it. Let's talk about shrink for a moment. For those learning the industry terminology, shrink is basically retail jargon for inventory losses caused by theft, basic error, or damage prior to a sale. It is a massive, incredibly costly leak in any retailer's financial foundation. Well, Dollar General achieved a 28 basis point improvement in shrink this quarter, which is completely wild, considering they are already lapping a 61 basis point improvement from the first quarter of last year. Exactly. They are actively compounding their efficiency. And the operational mechanism behind this is critical to understand. They achieve this by systematically pulling back on self-checkout lanes, putting human eyes back on the sales floor, and physically securing their high-theft product lines. It's a very aggressive, physical operational shift. By actively shoring up these costly leaks, they are permanently reinforcing their margin foundation for the future.
Section 3. Heavy lifting, SKUs, and real estate. We have looked at the financials, but now we really need to look at the physical operations. How exactly is management actively reinforcing their supply chain and remodeling their physical store network to prepare for the future? I am dropping the hammer on this specific metric right now because it is an absolute game changer for inventory efficiency. Over the last few years, Dollar General has systematically stripped away over 1,500 underperforming SKUs, that is, unique product identifiers, from their entire supply chain. Their chief operating officer, Emily Taylor, literally called this the cornerstone of their retail stabilization.
Right, and practically speaking, that means less clutter in the actual aisles. It means fewer trucks are needed to move dead product around the country, and frankly, far less chaotic backrooms for the employees trying to manage it all.
Precisely. It is a massive efficiency upgrade. This means significantly less decision fatigue for the consumer walking the aisles. It means drastically less labor required to physically stock the shelves. And maybe most importantly, it means a massive reduction in future markdowns on just dead, unwanted inventory. Listen, in a high interest rate environment, dead inventory is just trapped cash. It is dead weight. By shedding it, they create a significantly leaner, much more durable supply chain. In fact, their total merchandise inventory sat at $6.6 billion at the end of Q1. That is actually a 1.6% decline on a per-store basis. Think about that. They are doing more overall volume with a much less bloated inventory foundation.
Let me jump in here and look at the actual category breakdown because this is fascinating. You would think that aggressively slashing inventory might eventually hurt sales, right? But these leaner inventories are actually driving better in-stock rates on the items people actually want to buy. Consumables are up 3%, which, is totally expected. But checking the non-consumables is where things get really interesting. Home products are up 3.1%, seasonal goods are up 6%, and apparel is up a massive 6.7%.
That's exactly right. They are successfully leveraging strategic partnerships with brands like Kelly Williams in the home category and introducing Dolly Parton products to drive highly profitable discretionary spend. By cutting out all that dead weight we just talked about, they have literally made physical room on the shelves for the products that actually move the needle and yield much higher margins.
And they are not just remodeling their inventory, they are literally remodeling the physical foundation of the entire company. In Q1 alone, they opened 190 brand new U.S. stores and 5 new stores down in Mexico, bringing their total footprint to over 21,000 locations.
But they aren't ignoring the older existing stores either, right? They are actively reinforcing the existing structures as well, right?
Correct. They completed 659 full-scale remodels under what they call Project Renovate, which, by the way, targets a massive annualized comp lift of 6% per store, and they completed 711 lighter remodels under Project Elevate, which targets a 3% lift. This is continuous, highly aggressive capital expenditure designed to keep the network modern, highly functional, and generating progressively higher returns on invested capital.
Okay, so let's talk about the digital side of the house. I have to be honest, whenever I see a discount retailer like Dollar General and the term AI being discussed in the same breath, my skepticism immediately flares up. Like, is this just corporate buzzword bingo? Are they just trying to artificially prop up the stock price by saying AI a bunch of times on an earnings call? Look, it is a completely fair question, but the hard data points to some very tangible digital scaffolding being built here. Let's start with delivery. They now have a delivery reach across 18,000 of their stores. They are utilizing their own MyDG app alongside major partnerships with DoorDash and Uber Eats. And here's the kicker. 80% of those orders are delivered in under 1 hour. This digital fast delivery mechanism alone added roughly 70 basis points to their comparable sales growth. It's not a gimmick, it's driving real revenue. Okay, I'll give you the delivery part. That's real cash. But what about the AI? For the AI, management explicitly confirmed they are building out an enterprise AI operating system designed to completely reshape their supply chain workflows. Now, to be clear, we are not talking about some generative chatbot on their website. We are talking about serious predictive ordering models to ensure the absolute right product hits the exact right store before it sells out. We are talking about heavily optimized truck routing. They are shaving millions off their fuel expenses simply by finding the most mathematically efficient delivery paths across their 21,000 stores. They are aggressively digitizing the entire back end to drastically lower their operating costs.
Section 4. The verdict. Opportunity or trap. We have heavily weighed the structural macroeconomic pressures against the internal operational improvements. It is finally time to bring this debate to a close and deliver a definitive, data-backed conclusion for you. Let's lay out the 2026 blueprint. I'm still looking at the bear case here, and it is glaringly obvious. The core consumer is still heavily constrained, fuel costs are elevated and eating into daily household budgets, and general consumer behavior is highly uncertain right now. If a true recession hits hard, even discount retailers can feel the absolute pain if foot traffic dies completely. How do they survive that level of macroeconomic gravity? That is the structural risk, and it is entirely valid. But the bull case is heavily reinforced by management's updated 2026 guidance. Based on their massive Q1 outperformance, they actively raised their full-year earnings per share guidance to a range of $7.20 to $7.45. They are projecting net sales growth of nearly 4%. They are systematically expanding their margins, they are aggressively cutting shrink through physical operational changes, and they are successfully targeting and capturing those six-figure demographic trade-ins. Right now, the structural integrity of their operation is quite literally overpowering the macroeconomic gravity. So the crucial takeaway here is this. Dollar General is proving with hard data that they have the structural fortitude to weather immense economic pressure. By slashing inventory bloat, strictly managing their shrink, and capturing much higher income trade-ins, all while fiercely protecting their core customer with those $1 value items, they are forging a highly durable enterprise.
They definitely aren't without their risks, for sure, but they've shown they have the operational tools and the management discipline to patch the cracks and keep building upward.
Exactly. Now we want to turn it over to you. If Dollar General can post these kinds of numbers in a truly brutal economy, what happens to this stock when the macro pressure finally lifts? Is this the most ironclad turnaround of 2026, or do you still see a value trap hiding in the data? How are you forging your own portfolio in this current market? Let us know your thoughts in the comments below. Make sure to subscribe to Iron Financial for more rigorous, data-driven explainers just like this one. Keep your foundation strong, and we will see you in the next one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.